Tom Selzer and welcome to LiveWire's listed series. Joining me today is Adam Myers from Pengana to talk about one of the fastest growing areas in finance right now, private equity. Adam, thanks for joining us.
Pleasure to be here, Tom.
Adam, private equity's really come to the fore in the last decade or so, but what do you think is maybe the most significant shift you've seen over that time?
Over the last decade, we have seen significantly more economic activity and, by extension, economic value being created in private markets. Really innovative, dynamic businesses don't have to go to the public markets to raise capital. There's an abundance of capital available in private markets. And what that means is that investors who want to access that segment of the market need to do so with private allocations.
And I think a lot of investors associate private equity with high growth tech, but I know your portfolio consists of businesses across logistics, infrastructure, healthcare. What do you think makes those type of companies attractive right now?
Right now is probably not the lens that we should be looking at it through, because private equity is by definition a long-term investment. So when we are making these investments, right now is important, but the tomorrow's environment is equally important, and we can't necessarily anticipate it. And that's why I think the most resilient private equity programs will have a very stable base of diversified companies that are cash flow generative, that can grow earnings in resilient industries to provide that stability. And PE1, so the Pengana Private Equity Trust, will have a significant portion of our capital allocated to that kind of business. And what that does is it allows us to take targeted exposure to more high growth opportunities without materially changing our risk profile.
AI is obviously a huge theme globally at the moment. I know the portfolio has exposure to companies like Anthropic, but how are you thinking about AI opportunities in private markets more broadly?
So I think you have to think about AI in two ways. Firstly, it's the existing portfolio and the potential for disruption, because nobody wants to be invested in a company that risks being disrupted by technological change. And the second consideration is opportunistic. We think it's likely that the exceptional AI businesses will continue to emerge in private form and generate significant capital long before they ever think about going public. Poster children for the sector are probably OpenAI and Anthropic. Both are worth hundreds of billions of dollars, and they are still private. And smaller companies, there are a raft of less well-known companies in the private space that we're equally excited about.
And I think one of the challenges for investors is simply getting access to private assets. How does something like the Pengana Private Equity Trust open that door?
You're right. Historically, large institutions were more easily able to access private markets, and this was typically because they were better placed to deal with the complexity of investing and then the complexity of maintaining their investments, and also obviously the long-term nature better suited them. PE1 helps to bridge that gap, because we invest in a highly diversified portfolio of global private equity investments. We're targeting top quartile returns. But the difference is that we are listed on the ASX, which means that investors can come in and access this diversified global private equity as long as you've got a stockbroking account in a size that suits your portfolio.
And your strategy invests in co-investments and secondaries, but do you mind explaining what the difference is there?
Sure. We actually invest in all the implementation techniques, so primaries, secondaries, and directs, which are often co-investments. Primaries are initial fund investments whereby an investor will make a commitment to a private equity manager, and that capital will be drawn down over time as opportunities are identified and the portfolio is built out. Secondaries are effectively second-hand private equity. So somebody has already held that private equity interest and now, for any one of a number of reasons, wants to dispose of it. The advantage of secondaries, or the two advantages typically, one is that the buyer will have insight into what is in the portfolio, so there isn't the same blind pool risk that investors will face when going into primaries. And secondly, they are often acquired at a discount. And thirdly, co-investments are investments made alongside a private equity manager directly into an underlying company. These are often more, well, they are always more targeted, but they can be focused on sort of something strategic, risk minimization, a specific opportunity. For example, when we acquired our holding in SpaceX in 2020, that was a co-investment.
And it seems that I think returns in private equity can vary quite a bit. So how important do you think something like manager selection is in the asset class?
Look, I think that's a great observation. The difference in returns between the top cohort and the bottom cohort is significantly wider. Even the difference between the top and the mean or the median is much wider than we are used to in public markets. The key then really is manager selection and identifying the managers that are most likely to perform going forward, because past performance doesn't necessarily indicate future performance, especially in private equity. So identifying those forward-looking factors and then getting access to the managers, because actually some of the best managers limit who invests with them. And in private equity, there isn't an ability to buy a benchmark or get passive type index returns. So really outcomes are going to be driven by manager selection and manager access.
And maybe building on that, I think there's been quite a few liquidity events in the portfolio recently. How important are those for, I think, validating valuations and generating returns for investors?
Liquidity is very important, and there are a couple of reasons for it. Firstly, it allows capital to be recycled into new ideas, which is important. But secondly, the private equity holdings are typically valued quite conservatively in a portfolio. Managers don't have an incentive to aggressively mark their positions. And what this means is that when realizations or liquidity events occur, there's typically a nice pop in the portfolio. Importantly, PE1 primarily holds mid-market exposure, which means that while it's great that the IPO market is buoyant at the moment and we've seen a lot more IPO activity, we are less reliant on that, because mid-market holdings will normally realize through trade sales or mergers or management buyouts, things like that. So we don't have the same reliance on a buoyant IPO market.
And finally, for investors that are maybe more familiar with traditional equities, bonds, what role can something like listed private equity play in their portfolio, and how does something like PE1 fit into that?
Private equity has historically, on average, and I've already spoken about the dispersion of returns between managers, but on average it has historically outperformed listed equities, and it has also historically done it with lower volatility and lower correlations, which means that there are portfolio construction advantages as well. But I think actually the biggest advantage is that because more and more of the economic activity is now taking place in private markets, if you only allocate to public markets, you aren't getting access to the full opportunity set, and the broader your opportunity set, theoretically, the more resilient and more complete your portfolios will be.
Adam, thanks for joining us.
It's been a pleasure, thank you.
Thanks for watching. Make sure to check out our YouTube channel for more great videos.